When I put Judy's bond into the back end of this, which is really to me, makes tremendous sense. Her bond is deliverable in gold, right? So you sell a bond that is deliverable in 20 years, a certain amount of gold. Well, let's just say you sell a $20 million bond that's, it's deliverable in gold in 20 years, zero coupon. So the zero coupon would help tremendously in that you have zero upfront borrowing costs. You sell the bond, you get 20 million bucks, you build state-of-the-art manufacturing and train your people. You owe the gold in 20 years. Well, right now that's 5,000 ounces. Van Eck funds, this is not me saying this, okay? This is Van Eck funds. Their emerging market bond team came out recently and said, if the dollar really did lose reserve status, we see gold going as high as $139,000.
And we'll address the piece he wrote, I think, for the Wall Street Journal, New American Statecraft, which is essentially the United States going back to Hamilton-era monetary policy. Yep. Very key stuff, guys. But again, Price is not telegraphing that any of that is happening. And paper price misdirection, which Andy Schectman talks about just about every interview, is, I think, a spot on categorization for this. Paper price misdirection. So let's talk about quantifiables real quickly before we talk about percent. China has been buying gold at record levels for 20 months. I think last month, some 15 tons. Meanwhile, as Felix Pren noted in that video I was sharing on the phaser, Guatemala, Indonesia, Malaysia, Cambodia, and Kenya have never bought gold, but now they're buying gold. And meanwhile, on the 24th in Shanghai, something weird's going to happen. And again, Price is not telegraphing this at all. Here's Andrew Maguire.
As we outlined last time, our well-connected liquidity providers are preparing for the next week's 24th of July trading bank shutdown of the remaining sell-only Chinese speculative accounts. And one of the swap dealers were having a difficulty getting out of those positions. And what it was doing was signaling that unencumbered physical liquidity is being readied for the next batch of 400-ounce bars moving from London to Hong Kong. This is all about China putting the yuan on the gold standard.
All right, I'll pause it there. Is he right, Andy?
Yeah, look, this is not just gold moving from west to east. This is the market plumbing, moving from paper pricing of the West towards non-Western, non-dollar physical settlement. And so when you talk about China backing their yuan, I don't know if it's completely backed, but I will tell you that they've already made the digital yuan convertible into gold immediately without converting to dollars first and deliverable through the Shanghai Exchange in Hong Kong, where metal has to leave through Hong Kong. And so you look at their rails that they've set up, like CIPS, which is the Cross Interbank Payment System. China signed up recently the countries in Southeast Asia, the acronym ASEAN, ASEAN. These countries are 800 million people, Sean. They're twice the population of the West. China's already China's largest trading partner by far. Over 30% of global GDP is settling across rails that are not compliant with SWIFT and settling imbalances in gold through these exchanges. The Shanghai's aspirations are to make multi-jurisdictional vaults. Now, the first one is Hong Kong. The second one that reports say is done is in Saudi Arabia. They're going to do one in United Arab Emirates. They're doing them in ultimately in Switzerland and in London, and then throughout the entire Belt Road Initiative that will connect with the exchanges in Singapore, in Mumbai, in Dubai, in St. Petersburg, in Brazil, all around the global south and through the BRICS and the Belt Road. You will have rails like mBridge, which is now operational, cross-border payment system for central bank to central bank, and or CIPS that allow countries to trade in a multipolar way, their own currencies settling imbalances in gold. Case in point, China will buy oil from the United Arab Emirates or Saudi Arabia and pay for it in digital yuan, which, like that, is convertible into gold on the Shanghai Exchange in Hong Kong. But they're building them in United Arab Emirates and in Saudi Arabia too. So those take it out of the exchange in their own backyard. And this is instead of having one vaulting system like the LBMA, where Venezuela says, can we have our gold back? No, you can't. They're going to have multi-jurisdictional vaults, so that doesn't happen. In other words, it is settling imbalances in gold, whether it be trade or currency, trading in local currencies. And if you trade less in dollars than in other currencies. You need less dollars. And if you have less dollars, you need to recycle into less amount of treasuries. And so the real issue is de-treasurization, not as much de-dollarization as it is de-treasurization. And we can see that with the yield going up in the 10-year treasury. It's a problem. These countries are finding other ways to settle imbalances. And if you look at the performance of gold versus the 10-year treasury, it's doubled it over 25 years. It's 10x'd it over the last couple. So yeah, absolutely. The Chinese would be very smart because everyone says, well, who the hell trusts China? I say, who the hell trusts us anymore? And I love this country, Sean. I'm a patriot. I would do anything for this country. I thank God I was born here every day. But people don't trust us anymore because of what we did with the Treasury market and weaponizing it and fiscal irresponsibility and all the like and the divisiveness that we see in this country. So how about we trust gold and we trust blockchain transparency? Settlement in gold. You can take the yuan and convert it into gold. And so, yeah, these things are happening. Andrew is right. He's a buddy of mine. He's brilliant, and he is ahead of the curve, and he's dealing in the wholesale market. He's seeing it before most of us do.
Let me ask you this before we get back to Besant, or maybe we should get to Besant first. Where does the Judy Shelton case for 50-year gold-backed bonds fit into this? Now, Independence Day came and went, and none of us were really expecting Trump to say, "Hey, we just revalued, the dollar, and it's tied to gold, and gold, we just revalued our gold in Fort Knox, and now it's 10, 15, 20,000 an ounce." But meanwhile, there are futures contracts that seem to be building in size that are betting on $20,000 and $30,000 an ounce gold in December.
Yeah, the day of we're recording this today. What is the day? The 16th, I think.
Yeah.
The U.S. Mint just today, you can buy the 1 ounce gold Liberty medallion. It's being sold for $19,500 right now today. Just
what's
opened
that
up
all
on the
about?
Mint. And look, I never revaluation to me is less of a reality than Judy's idea is, and I've been pretty consistent on that, except for the fact that you got guys like James Rickards saying $24,000 gold, which would give the Treasury $6 trillion free and clear. And I mean, James Rickards is a smart dude. It's interesting thought. They should at very least market to market, right? It's valued at $42.22 an ounce, and you heard Besant in that interview say, well, it's $1 trillion value right now at mark to market. So the bottom line is that at the very least they should. Now, Judy's idea, I've interviewed her twice. Michelle interviewed her once. I interviewed her once on my channel. I've read her book, and I've watched every interview she's done. And she's one of the most brilliant human beings I've ever talked to. Incredibly smart. She told me, Andy, in no uncertain terms, that Trump understands this. When I was part of the transition team, he told me that July 4th was the biggest day of his presidency, 250th anniversary, and I truly believe there is a high probability he will announce a gold-backed treasury. 50-year at first, she said, 30, 20, 10, 5 subsequently. Zero coupon on all of them but the 50, 1% on the 50. In an effort to reinstill confidence in the Treasury market. Now, I will to this day, Sean, tell you it is the finest idea I've ever heard. Because you have a situation where we're 40 trillion in debt and 160 unfunded liabilities. We make nothing anymore. That's Triffin's dilemma. Where you mentioned Cambodia, I use Cambodia as an example all the time. We don't do much trade with them. Triffin's dilemma says we can't give the world enough in the way of dollars just through trade alone. So countries like Cambodia would need to sell dollars or their currency in the open market to buy dollars, to buy energy and other things. So over time, this creates a massive discrepancy between the two currencies. So someone gets the idea to move manufacturing to Cambodia, make 10x. This is how you hollow out your manufacturing. The knucklehead that is Jared Bernstein, who humiliated himself trying to explain how treasuries were created under the Biden administration, the chief economic advisor, did write a report called Dethrone King Dollar that explains Triffin's dilemma, that we cannot be the reserve currency anymore. And Vice President Vance says it all the time. It's a privilege we do not really deserve any longer. We can't afford it because we've hollowed out our manufacturing. So we make nothing. We're 200 trillion in debt. Ray Dalio says 60% of the country has a literacy rate below that of the 6th grade, so we're uneducated. Just in time for AI to come and kneecap jobs, as Ken Griffin, The Wall Street hedge fund guy just came back and he said, I was really, really sad when I came back from visiting my office, I think in Connecticut. He says, because I'm watching right now in real time. This isn't some futuristic thing. This is right now. I'm watching AI do projects faster than the employees that I'm paying 7 figures a year as analysts to do, and they're doing it better and faster. This will disrupt the white-collar market unlike anything, he says. So we're broke, we don't make anything, we're uneducated, just in time for AI to kneecap. How do we give our children a future? How do we bring back manufacturing? And I was listening to Luke Gromen. He said something really interesting. He's like, there were more manufacturing jobs created under Biden than under Trump. This is coming from the military-industrial complex. This is coming from above the White House. This is a national security thing. Well, how do you bring back manufacturing? How? You can't with Triffin's dilemma. And I'll give you a quick parable. When the Swiss stayed out of the European Union, they said, we're going to stay out, and they're an export country. And our business was founded on Swiss investments back then. I told everyone they're lying. They're going to peg their currency. They can't not do it because they sell watches and chocolate to all the countries in Europe. And if they do not peg their Swiss franc, even though they stay out of the Union, to the euro, they're dead. Because who wants to convert to a super high price, strong Swiss franc first to then buy the watches or the chocolate? You'll forego the sweetness and buy the chocolate from Belgium, and you'll buy watches from France because it just costs too much. So it's the same thing with the reserve currency here. So what do? You soft default on the reserve status to bring back manufacturing, to pay down the debt. Now, how do you do that? Well, we just said Triffin's dilemma is that every country sells theirs in order to buy ours to buy oil, right, over time. So you're measuring the value of the dollar when you're looking at the dollar index against a melting basket of currencies. Instead, measure it against gold, as Roosevelt did when he confiscated gold in 33 at 20 bucks an ounce and then devalued the dollar by 40% to $35 went gold. What if you had a proxy entity, just like I was saying on the commercial bank side and COMEX? What if there was a proxy entity on the other side to help you do this? Now, Judy's idea would fit hand in glove with this, but even if we take Judy's idea out for a moment, you look at the Genius Act that goes into effect in January, Sean, and it says anytime money moves, I don't care if you buy a pack of cigarettes or a new house. If it's in dollars, it will move via stablecoin from January forward. For the rest of time, the movement of stablecoins will be instant settlement, but it will be backed by short-term treasuries 90-day or less. First thing that does is it kills the dual mandate of the Fed. And Trump, a lot of people think, are out to get the Fed, right? So why does it kill the dual mandate? Because if it's 90-day or less treasuries that are being created and backing money movement of any sort anywhere on the globe in dollars, you're creating insatiable, ridiculous synthetic demand for the front end of the curve for short-term treasuries. You pin the market to the floor. Now, the Clarity Act says, and by the way, that interest, guys, that's not transferable. So if I owe you $1,000, Sean, and I send you however we send it, whichever way it gets sent, it's backed by stablecoins, backed by 90-day or less treasuries. When I send it to you, the stablecoin is created. When you receive it, burned. The interest on that treasury backing the stablecoin movement is not transferable. So what's Tether doing? The largest holder of it, the largest issuer and the largest holder of treasuries, they're buying more gold than anyone in the world, except the Central Bank of Poland, which I'd like to read you at the end, a comment from the Central Bank of Poland. But they're buying more gold than anyone in the world but them, which ultimately, as gold would go higher, would devalue the dollar. Now, Tether was in trouble for a while with the Justice Department. Kind of interesting how that went away. Their CEO of their new division, which is stablecoin, which is USD or Genius Act compliant already, sorry, I'm battling a cold, is Bo Hines. And Bo was Trump's crypto czar through last August. He's his confidant. It's kind of like Stephen Mirren just somehow stumbling into the vacated spot at the Fed. He's the guy that wrote the Mar-a-Lago Accord. Bo Hines is now the CEO of USA Tether. So what if the deal was something like this? You guys are going to take the interest. You're going to make tons of money. Whenever you get that interest, you're going to buy gold. Because buying gold will devalue the dollar. It will revalue the price of gold organically, even though it's being achieved synthetically. And we won't have to step into the market and say, this is where gold is right now and create this issue. We'll just let gold go higher and higher and higher and higher and higher and higher because you'll keep buying it with all the interest. You'll devalue the dollar more and more and more and more. You'll sell that gold to the U.S. Treasury over time quietly, but you're going to be proxy for us. So our footprints are not in the snow in the gold market through Tether or in the commercial bank market through COMEX. And you're going to accumulate this for us, but ultimately you're going to devalue the dollar and allow us to reshore manufacturing. All you hear about is reindustrialization of the United States. Well, if you have a strong dollar, you will not work. It will not work. You will fail. Period. End of story. So what this tells me, this is why the central banks are buying gold and silver hand over fist, because they know, they know where the puck is going to, like Gretzky did. He knew where the puck was going, not where the puck is, because they know ultimately it is of a debased dollar, it is of lower interest rates, it is of easing in a weaker dollar, or A, you'll never pay off your debt. B, you will never give our children a future. You will never, ever bring back manufacturing, and you put this country at a big disadvantage from a standpoint of national security. So, is there a fine line between conspiracy and reality? Absolutely. Am I surmising this is what this could be? Absolutely. Now, when I put Judy's bond into the back end of this, which is really to me, made tremendous sense. Her bond is deliverable in gold, right? So you sell a bond that is deliverable in 20 years, a certain amount of gold. Well, let's just say you sell a $20 million bond that's, it's deliverable in gold in 20 years. Zero coupon. So the zero coupon would help tremendously in that you have zero upfront borrowing costs. You sell the bond, you get 20 million bucks, you build state-of-the-art manufacturing and train your people. You owe the gold in 20 years. Well, right now that's 5,000 ounces. Van Eck funds, this is not me saying this, okay? This is Van Eck funds. Their emerging market bond team came out recently and said, if the dollar really did lose reserve status, we see gold going as high as $139,000. So you take $20 million, let's just say they were right, divided by 139,000, that's 144 ounces of gold in 20 years,
right,
if that were to happen. Now you deliver that bond, it only takes 144 ounces of gold instead of 4,000. You've wickedly devalued the dollar. You have zero upfront borrowing to reshore manufacturing, and you look the world in the face and you say, we have consumed more than we've produced for 50 years, 80 years. That's going to change, 50 years for sure. Now we're going to produce more than we consume. We're going to give our children a future. And this is the only way, because Richard Russell was my mentor. And Richard used to say to me, Andy, the Fed has two choices. They can inflate or they can default. Inflate or die, because we consume more than we produce. And Sean, I don't know how young your kids are. My youngest is 19. But, kids and grandkids, if we don't change things, are going to grow up in a world where we're broke, getting more broke, borderline insolvent, with no manufacturing, IT destroying job creation or jobs, period, and, an uneducated populace. We need to do something. And if he is really trying to reindustrialize the country, the only way that it will work is to default quietly on the reserve status. In other words, let the dollar go. The moral of the story is you save in dollars, you go broke. You own assets like the Cantillon effect, you become wealthy. And that is what I think they are doing, because what other choices do we have? How do you bring back manufacturing? And if you do, how do you sell it into an ultra-strong dollar as a reserve currency? You don't. So this is kind of my thesis. I think Judy's idea is the best I've ever heard to this day, and I think it's not a dead issue yet. But it would be great if it came about. I don't think it has to. I think Tether is a key element to this, and other companies like them who take the interest accumulated through the synthetic demand for U.S. Treasuries and buy gold to devalue the dollar, to push gold higher, to restock the Treasury, which then makes it easier, again, from a debt to equity standpoint to, kind of rise from the ashes, if you will, if that's an appropriate analogy.